Silver did not collapse because a mine flooded or demand suddenly disappeared. It did not crash because solar factories shut down or electric vehicle targets were slashed. It fell because the structure of the market changed almost instantly. While prices surged into the mid-80s just days prior, a quiet policy shift flipped the story. The CME raised its margin requirements for silver futures contracts, and that change triggered everything. In a matter of minutes, positions that had seemed stable became unsustainable. Traders who were long on leverage were forced to act not by choice, but by survival. They were not selling because they believed silver was overvalued. They were selling because the rules moved and staying in became too expensive. What followed was not a typical correction. It was a cascade, not driven by fundamentals, not justified by the real-world market, but mechanized, automatic, brutal, and fast. And while most headlines focused on the fall in price, very few noticed what really changed that day. This is not a silver story, it is a leverage story. And behind that story is a much bigger message, one that every investor needs to understand before it happens again. In the early hours of a quiet trading day, the CME made a decision. It raised the margin requirements for silver futures, meaning anyone holding a leveraged position suddenly needed to post more collateral to maintain it. To most casual observers, this sounded like a harmless technical adjustment. In reality, it was a fuse, because in futures trading, most contracts are not fully funded. Traders post an initial margin, a portion of the total exposure, and maintain that balance as long as the position moves within tolerance. But when a margin hike takes effect, those requirements can rise overnight. This creates a chain reaction. First, brokers recalculate risk. Then they contact clients whose accounts are underfunded, demanding more cash, often immediately, and if that cash cannot be posted, liquidation begins automatically. No negotiation, no delay. This is what unfolded in the silver market. Positions were closed not because traders lost confidence in silver, but because they ran out of runway under the new rules. Thousands of contracts were dumped, not out of fear, but out of obligation. This kind of forced selling has a signature: steep drops. Thin liquidity and price cliffs that seem to defy logic. Because they are not guided by logic, they are driven by margin math, and timing made it worse. The hike hit during a holiday stretch when the market was already thin, amplifying every sale, triggering more stop losses, and compounding every move downward. This was not a natural shift in buyer sentiment. It was engineered by design, through structure. The margin changed, the math changed, and that was enough. Market crashes often look emotional, but when leverage is involved, they are usually mechanical. The drop in silver was not a panic, it was a purge. When thousands of traders use borrowed exposure to take long positions, the system works fine, until the rules shift. A margin hike does not just raise the bar, it resets the floor beneath them. Here is what happens next, the moment new collateral is required. Every position holding too little cash is flagged. Tight accounts generate margin calls. Calls force responses. Either wire in money immediately, or your broker exits the trade for you, and brokers do not wait. They liquidate positions as fast as possible at whatever price the market offers. This is not selling rooted in opinion, it is selling by force. Now, multiply that by hundreds, even thousands of accounts. Stop losses get triggered, market sell orders stack. Each price drop sends another wave of stress into the system. Selling creates lower prices, which activates more forced selling. The spiral feeds itself until it drains the imbalance. This is why these drops can look like cliffs. They are not moments of debate, they are evacuations. And like any evacuation, they do not filter who's right or wrong. They simply remove the weakest first. Those without capital flexibility, meanwhile, liquidity vanishes. Fewer buyers step in. Spreads widen. Every move becomes more volatile than the last. Investors often mistake this for sudden rejection of a commodity's value, but that is not what is happening. The structure collapsed, not the belief. Silver did not fall because people no longer value the metal. It fell because the mechanics of leverage do not allow slow exits. When the price of silver collapsed on trading screens, many assumed the entire market had turned bearish. In reality, something very different was happening, because the price that moves in moments of liquidation is not the physical price of metal bars, coins, or industrial supply. It is the paper price, the futures contracts traded electronically, representing promises to deliver metal in the future. And when margin calls hit, those paper promises are dumped, quickly, automatically, at all costs. But paper trades do not come with trucks, vaults, or actual metal. They are leveraged bets, claims, not coins. Meanwhile, in the physical market, the world of refiners, manufacturers, industrial buyers, and bullion distributors, the story might look completely different. Premiums stay high, inventory remains tight. And in many cases, buyers increase purchases the moment paper prices drop, seeing it as an opportunity, not a warning. This creates a disconnect. Screen prices fall, but physical metal holds or even rises in demand and delivery cost. And when that divergence widens far enough, it creates a tension. Either the paper price must rebound to reflect real-world demand, or physical markets begin to dry up, exposing just how thin the supply really is. This is why short-term price crashes should never be accepted at face value, because they do not always measure sentiment. Sometimes they measure structure, and in silver, that structure is unusually fragile, especially when physical supply is constrained at the same time that leverage is breaking down. A chart may show panic, but shelves spreads. And wait lists may say the opposite, and knowing the difference can separate emotional reactions from informed decisions. Margin events do not just move prices, they move ownership. When leveraged positions are flushed out, the metal itself does not vanish, it changes hands. And that is where the quiet shift happens. The traders forced out first are not always wrong about the long-term fundamentals. They are simply the most exposed to short-term pressure, unable to meet sudden margin calls, scrambling to exit positions before liquidation kicks in. They feel the full weight of structural changes in real time, and they lose their claim to the asset, regardless of future value. But someone is always on the other side of that sale. Buyers with cash, institutions with capital flexibility, long-term holders who do not need leverage to build a position, sovereign players who can accumulate patiently without media attention or quarterly pressure. These are the market participants who benefit from margin-driven sell-offs. They step in when the price does not reflect the asset's fundamentals. And as panic builds, they do not flinch because their time frame is completely different. This is the strategic layer few talk about. That margin sell-offs are often forced wealth transfers from those who guessed right but bet too aggressively. To those who are prepared to wait out the volatility, it is not a conspiracy, it is consequence. The system is built to reward patience and punish fragility, and in a structural sell-off, survival is not based on what you believe about the future. It is based on how much pressure your position can take today. When the dust settles, it is the cash buyers left standing and holding. Events like this are not new. Silver has a habit of teaching the same lesson every few years, just dressed in different charts, different headlines. And different headlines in 1980. Silver surged beyond what the system could handle. Then came position limits, margin hikes, liquidity crunches. The price crashed, not because silver suddenly lost value, but because access to it became more expensive, more restricted in 2011. The pattern returned. Silver rallied hard. So did margin requirements. Each increase forced new rounds of selling, and one after another. Investors were pushed out, not because demand collapsed, but because they could not remain exposed under tighter rules. Now, in 2025, the script reads nearly the same. And the next part will not be written by headlines, it will be written by signals. Signals like physical premiums, are buyers still willing to pay above spot for actual metal? Signals like inventory drawdowns are major vaults and exchanges quietly running out of supply. Signals like delivery behavior are traders taking physical settlement instead of rolling contracts forward. These indicators tell us what really changed or what did not. Because a sudden drop in the chart might look like silver has been rejected, But the physical market may say the opposite. That divergence is not just noise. It is warning and opportunity at the same time, if you truly want to read the future. Do not just stare at the price, watch who is still buying. Watch what disappears from inventory. Watch what cannot be printed. That is how you stay prepared. Not just for what comes next, but for what always seems to come back again.